This week's recording is being made while I am attending the Spring Residential Tax Conference of the Institute of Taxation, but more about that in the coming few weeks. I'm sure we're going to have plenty of tax changes and tips to share with you. But this week I wanted to give you some time-limited advice, and this arises from the changes in the taxation of dividends. If you are a shareholder director, then this requires your urgent attention. I recently came across a quote, and you'll see it appearing on your screen now. The changes to the taxation of dividends is just another example of how the present government views small owner-managed companies. So let's start off by having a look at what changes are in store. Under the present regime, which comes to an end at the 5th of April, dividends were received with a 10% tax credit. This effectively meant that if you're a basic rate taxpayer, you paid no more tax on dividends received, and many of you would have been using a low-salary dividend profit extraction strategy. From the 6th of April, this is all going to change. The 10% tax credit is being abolished, and you'll receive your dividends gross. The first £5,000 of dividends will be taxed at 0%, and above that there will be a series of tax rates depending on whether you're a basic rate or higher rate or additional rate taxpayer. If your earnings are quite modest and covered by your personal allowances, then any spare personal allowances will be used to set off against your dividends, and then the £5,000 allowance will be used against the rest of your dividends. In this scenario, you would be able to have income of £16,000 before paying tax. I would like to highlight a number of implications of the changes. Firstly, you have to remember that the allowance is not a deduction, and so will still be counted for higher rate child benefit clawback, abatement of personal allowances, and also your qualification to transfer personal allowances between spouses. Secondly, do you make gift aid payments? You must have paid tax of the same amount as the charity will be reclaiming under gift aid, or the revenue will come after you to collect the tax directly from you. In the past, you could use the tax credit on dividends, but no more. You will have to actually have paid the tax. A bonus of the system is that the new dividend allowance will be available to everyone, no matter what's their marginal rate of tax. So somebody who is earning higher rates of tax can still have £5,000 of dividends tax-free. Of course, the big downside is the fact that most of us are going to end up paying more tax after 5th of April 2016. So if your current strategy is to take a small salary and about £30,000 of dividends, then you're going to end up paying at least £2,000 more tax. That was a quick review of the changes which are coming, but I would now like to turn my attention to what you should do before the 5th of April, and that is to look at extracting the maximum dividend you can before the new rules start to bite, and I've outlined the process on the screen. And this is something we will be looking at for all our clients over the next few weeks. So if you've had a look at your reserves in your balance sheet, you've looked at your basic rate band, you have to decide whether to declare or to pay a dividend. If you have the cash, it's good to pay it, but if you don't, there's an alternative. And this is to declare a final dividend. The way you do this is to hold a meeting of all the shareholders. The shareholders look at the figures and decide to pay a dividend. The meeting is minuted, and the amount of dividend is entered into the accounts as a balance outstanding to the shareholders, which can be paid out at a later date when cash flow permits. Now, it is very important that the meeting is properly called and documented, and on the screen you will see an example of a typical minute of such a meeting. As you will see, it is quite simple and straightforward. Now, once the dividend has been declared, it will be entered onto the shareholders' tax returns according to the date of the meeting. In order to get the beneficial tax rate, the meeting must therefore take place no later than the 5th of April. If you're actually paying a dividend, then the relevant date is the date of payment. This of necessity has been a very brief outline, but the important thing here is that you take action before the 5th of April. So come and speak to us if you need some help. I'm Alan Long from the Long Partnership, making life less taxing.